Let's start, if we could, by trying to get your thoughts on the GameStop situation, but really because it's a microcosm of so many things going on in the marketplace all at one time, right? You have sort of the social media-enabled interest in this stuff. You have these new apps, the gamification of it. You have these issues about payment for order flow. It captures all of it. But in terms of risk and how you're thinking about it, what's top of mind right now?
Well, first, let me say thank you, Andrew, for inviting me back. It's good to be back on Squawk Box and to see Joe and Becky as well. Look, I think that markets evolve and technology comes along and changes markets on a regular basis. But what we're seeing in the markets right now, as we're seeing across the country in everything that we're doing, is we're able to use our apps, God, bless, because we can get so much more access, and we're bringing more access to the capital markets for retail investors. But we also have to look out for our core principles. Our core principles are protecting investors and fair, orderly, and efficient markets and capital formation. That's written into the law, but it makes sense today, just like it made sense when it was written into the law. And so how do we update our regime, our reform our rules to still protect investors when these apps are sort of encouraging active trading through the behavioral prompts? And then our whole market structure is starting to see some concentration in it, and that could sort of diminish efficiency in our markets.
Well, let's talk about both of those issues. In terms of this issue of gamification, and you were asked and talked about this in the hearing yesterday, you clearly have concerns about gamification. The question is, to the extent you want to regulate that, how do you do it?
Well, it's about sales practices and the marketing and communication with investors. And for a very long time, the SEC and its self-regulatory organization, FINRA, that you might have heard about yesterday during the hearing, have looked at these things. So we're going to seek comment from the public about these new tools, about prompts and leaderboards and behavioral ways to get individuals to trade more. And look, there is a bit of a conflict of interest. An app that says that they have zero commissions is earning revenue on your trading, the listeners to your show's trading, through something called payment for order flow. Somebody is paying them for that order flow and paying them for that data. We know this is to be true when we go on any application, somebody wants to get our data. But so we're going to take a look at this and get public comment and then see how we might freshen up our rules.
So, Chair Gensler, on that issue of payment for order flow, and we've had Ken Griffin on the program, we've had Vlad Tenev from Robinhood on the program, and so many others who've made an argument that because of the lot sizes for retail and the like, that they're actually getting better pricing, is the argument they say, for their customers. And so that they're saying it's not costing the end user. Do you believe that?
Well, there's evidence that shows that there's a conflict. We had a case settled in December of last year where the wholesaler in that circumstance actually had written to the broker and said, there's a trade-off. We could give you more payment for order flow, or we could give you better execution for the customers. A clear sort of trade-off. And there are brokers that don't take payment for order flow. And as I noted yesterday, the United Kingdom, Canada has banned it. So we're going to take a close look as to how the market structure can work best, be most efficient, and protect investors.
But in your mind, though, do you see a solution being the issue of more disclosure, meaning as long as the customer knows this is the arrangement, it's okay? Or do you think the possibility of banning it is real and that might be a better solution?
So, Andrew, we're still at early stages. I'm in the third week in this new job, and I'm so privileged and honored to be in this job that President Biden asked me to do it and the Senate confirmed. So I want to hold off on that, but I would say this: disclosure alone may not do it. And there's times where there's an inherent conflict, and then thinking about what the market structure can be to be best for investors, but also for issuers. See, if we have concentration in the middle of our capital markets, concentration tends to lead to higher prices and more fragility. And that means even issuers accessing the markets know that there's a gatekeeper or an individual in that middle that can extract what's called economic rents.
Chair, you made a point yesterday that Citadel Securities has publicly stated that they effectively execute about 47% of all trades. Is that too much? And to the extent it is, or it's something you're concerned about, what kind of solution do you see?
Well, again, we're still working on it, but I'll share something else. If you or I put a market order in, again, I don't any longer because I'm the chair of the SEC, but beforehand, put a market order in on a retail platform, the vast majority, well over 90% of those go to these wholesalers. It doesn't go to the lit markets like the New York Stock Exchange or the NASDAQ or in an options world, Chicago board and so forth. A lot of these are really just going to the wholesalers, and they're not as lit, they're not as competitive. So it's not clear that we're actually getting best execution in an unlit, internalized wholesaler as contrasted to the lit markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.